Hey, this is your man Myles, and this is the Real Estate 360 podcast. Today, as always, as I love to have my mans on the show, we got Steve rocking out with us today to talk about real estate. We had a great show last week. We're going to talk about everything that we're going to be doing, but more specifically, in this particular episode, we're going to talk about the advantage of cash flow moving into this type of economical cycle that we're in. So, you ready, Steve?
I am ready. Yes, sir. By the way, hashtag unemployable.
That's right.
You know, when you start doing this stuff, people may not want to hire you. So be careful.
That's right, you guys. So, get your pen, get your pad, take your notes. We'll be right back after this. All right, guys, we're back. We are back to the Real Estate 360 podcast. This is Jason O. Myles, hashtag the real estate trainer.
Steve Connolly, hashtag unemployable.
That it
Been at
is.
this for a while.
just a couple years, I would imagine.
Yes, sir.
So, Steve, we're getting a lot of questions about, what do we want to do? What can we do? We're having people reach out to us on an from a student level that, they want to learn how to fix and flip. They want to learn how to wholesale. And, it's a great time to learn some of those techniques and habits. But the reality of it is it's tough to find wholesale deals today. They're still out there, but they're not in the abundant amounts that we had them, just a few years ago. So it's really tough. I mean, we're still finding them, but we're probably
Yes.
finding, our numbers we're finding about 20% of the properties that we were finding prior in the manner that we like to find them. There's,
Exactly.
it's not that there's a shortage of opportunity. It's that values are so high, so when home values have gone up, the people that own these houses, they watch the news or some version thereof, right? And so they know home values are up. And no time greater than now, Steve, have I witnessed so many people believing in the Zestimate. I I mean, I simply cannot believe. I mean, I can believe it, but it's so rampant right now. I was telling you about this house that we looked at over the weekend, and these people want $250,000 for this house. It's worth a top end 320, right? And that's fully renovated, retail ready, open floor plan, granite countertops, the whole nine, right? This house didn't have HVAC. It was renovated. It was technically move-in ready, but guess what? You walk in the front door and you're literally walking into a diner.
A what?
A diner.
A diner.
A diner, complete with the,
Wait a
you know,
minute. I thought you said this was a house.
it was a house. It is a house. It's a rooming house, actually. I forgot to tell you that part. It's also a rooming house, so it's segmented. I mean, it's in good shape, but it needs to be fully renovated because of the way it currently presents. I mean,
Well, how were the prices?
we're walking into Mel's Diner every time you walk in the front door.
Well, how were the prices? For the patty melt.
Yeah, I did ask. They did have they did have a malt machine though. They did have a malt machine.
What? Oh my gosh,
Yeah.
that's crazy.
I'll send you the pictures, but it was ridiculous. But the people that own it are so far outside the realm of reality. I made them a different offer. We made it yesterday, as a matter of fact, because we told them what we were willing to pay for the house, and they were insulted, like truly insulted. Initial offer was 150. Our maximum offer was 175. So we came back and said, look, we can do 170, but they're dead set on 250. Now we know they're not going to get 250. I mean, if they hold it for another 5 or 6 years, provided we have the kind of growth that we have now, which we're not, then they would probably be able to sell it for 250. But so I made them another offer yesterday that they didn't spit on right away. and that offer was to partner with them. Say, hey,
Oh, okay.
you put up the house, we'll put up the renovation budget, and then we'll split the profits 50-50. Now, you're not going to make $250,000, but you're going to make a lot more than 150.
Yeah, that makes sense.
You know,
Well,
so
what
it
about all the other questions like what's their back end financing? What about the cash flow of the house as it sits right now as a boarding house? Is that really strong or is it
no,
weak?
at a $250,000 price point, it's very very weak, right?
Okay,
So if
gotcha.
yeah, so if we were to go in even with owner financing at a $250,000 price point, it just we'd probably be at best case scenario we'd be in a situation where we'd be paying about $1,200 a month, right?
Mm-hmm.
Which for them would be for the current owners that wouldn't be enough for them to move on, right?
Gotcha.
There wouldn't be enough for them to move on. They'd be taking a pay cut to move
How
on.
much how much does the diner portion bring in? How much money does that bring
No,
in?
they don't do it. But the property
I'm
is
kidding around, of course.
yeah. But they've got 4 beds that stay rented at $200 a week, roughly $800 a month per. So
Wow. Okay.
per tenant. So they're $3,200 roughly a month. So for us to come in and even offer half of that would be um, would be tough for them, right? It wouldn't be a situation where they could go on. But again, there's room for improvement over there, but we'd have to spend the money and so on and so forth. But the point I'm trying to make, it's a bad deal for us the way we want to do things, and if had that property, let's say, been renovated the way, maybe not to perfection, but in that neighborhood, we can do an owner financing. We could do it with them for 250, pay them what they want. If the house was in better condition, okay, and then just immediately just clean it up, maybe put some paint on the walls. Very simple. Don't spend any more than a few $1,000s in doing that, and then lease optioning it to someone else at 280 or 290, knowing that the values are as high as 320,000 over there. So, those are the kind of things that we'd be looking at in this particular economy. Because guess what we have now, Steve? We're we're in a situation. I was reading an article that CNBC had. I read it in January, so I read it last month, but it came out in the middle of December, talking about the rental numbers. So I read the article, and then they had a video about it. Which, by the way, I'm going to share that article in the description. There will be a link to that CNBC article in the description to this. But they talked about the numbers from the fall of 2021. I'm just paraphrasing right here. It says the numbers suggest that rents will increase at a rapid pace in the coming years. Okay, years. There's a problem for Americans. That's a problem for Americans because many spend 30% or more of their income on rent, and that's been a decade-long slowdown in house building. Now, there hasn't been a slowdown in house building. There's been a slowdown in house building that's affordable, right? So, even though the article talks about affordability, it's coming from a rental perspective. And we are going to see that. We are going to see those rental values continue to go up. And until values, as we discussed before, until values for homes begin to slow down, let's just say slow down, or at
Mm-hmm.
least plateau, right? Until that occurs, we're going to see people that are earning, 80, 85,000 and up continue to buy these $450,000 new builds that are pricing everyone else out of the market. Now, what we will see when that happens is the rental market shooting sky high, and houses, the regular houses that we're going to be getting, Steve, are going to be still valued at what they are, but because a one bedroom apartment right now is $1,800, $2,000 a month, right? And we're talking about in Metro Atlanta, in certain areas of it, right? It stands to reason that someone that wants a house would be willing to pay more for more, right? So you could take
Right.
a two-bedroom, two-bathroom house in that same neighborhood and sell it for 450,000 dollars, maybe even a $500,000 right now, with interest rates being as low as they are. And that person that was spending $2,000 a month for a one-bedroom apartment will feel satisfied with that acquisition. Now, having said that, the person that's selling that house, Steve, they know the house needs to be renovated. They know what the values are in the neighborhood, but they also know what the rental market is bringing in the neighborhood. So they're not going to sell it at a super discount just because it needs some renovation. They're going to sell it at a relative discount because they know you can get $2,500 a month or $3,000 a month in rent for that house.
Right.
You know, and and that's what I'm seeing occur in the market. I mean, it's amazing to see. We were having a conversation before we got on today about rising rental prices. People that work with us that are renting in apartment buildings are looking at, in my neighborhood, a three-bedroom apartment a couple years ago would have cost, maybe $1,600 a month. That's well over $2,000 a month now. And they want the people that are moving into these apartments to earn three times the asking rent minimum.
Exactly.
So when
And
you, I mean, think
yeah,
about that for a second, right? So let me point out this one article, okay, Steve?
yeah. That article you're talking about also, it says in there that the rental rates are going to increase an average of 7.1%.
Potentially, yeah,
Yeah,
potentially,
that's a big increase.
it's huge.
Uh,
I mean,
yeah.
let's look at here. Okay, so here's an article, and by the way, guys, I'm also going to share a link to this article in the description as well, so you can read the whole article. Okay, so this was January 17th. This one came out. It's the U.S. Rental Property Outlook, done by uh, Managed Casas, which is an investment management company, right? So just to point out a few key pointers here. Enjoy further insights to the state of the rental market report, which includes, okay, the market is growing size enough for rental property investors, property managers, landlords, and tenants to feel confident in the market going forward into 2022. We had a growing size just before the last crash in 2007. So what do they mean by that? Okay, so what they mean there is before 2007, and Steve, you and I were talking about this as well. But before
Yes.
the financial crash, there were condo conversions happening like crazy all around the country. They were buying apartment buildings, converting them into condos because there was a shortage of affordable housing, right? And people wanted
Hmm.
to own. And so they could go in and they could buy these apartment buildings, fix them up, and sell them for 180, 200,000, even $250,000 a unit, and that was considered, to be, affordable, right? Relatively speaking, and
And
again,
that made a lot of sense at the time, because you buy the apartments on a per door basis,
hmm
maybe it's 30, 40, 50, 60,000 a door back then.
yep,
And then you turn around and you sell it for $180,000 after you put, 30, because it's an apartment. You don't have to redo the whole outside and everything and put landscaping in and all that. You just really it's a redo on the inside.
that's exactly
Made a
right.
lot of sense.
Yeah,
It was a big moneymaker until people stopped buying
that's for sure.
them.
And they stopped buying them as soon as the crash occurred. I mean, it was a wrap.
Yeah.
So it was just a wrap, and there were a lot of people left holding the bag in those situations. But that's what we had. We had this huge buildup. It was different than what we have today, though. So when I read articles like that, or parts of articles like that, I'm looking at that and saying, okay, but there are significant differences in the market conditions from '07 to 22. I mean, there's significant
Huge
differences.
differences.
Absolutely.
Huge.
They're nowhere near the same. I mean, now, there's still a shortage of affordable housing, but people are buying apartment buildings not because they want to do conversions, but because of the increased value in the rental market. That's why they want to do it. And
Right.
why is that? Why do you think that is, Steve?
Well, cash flow, it really comes down to they can make more money.
Yeah,
And it's always about that, right?
right. Well, it is. I mean, the reason for that is you have a shift in mindset of buyers today. That's the biggest
Exactly.
reason.
The
Think about
demand
it now.
side.
Yeah,
Right. Of
it's the
course, the
demand
demand.
side. It's always on the demand side. If there was more demand, truly more demand for affordable housing, we'd see that again. We'd see those condo conversions again. We'd see it again. But there isn't. People would prefer to rent. Now, that was 15 years ago, right?
Right. At
15
least.
years ago. So, who are the buyers today? The buyers today are millennials. 15 years ago, the 30-year-old was 15 and in high school and was more than likely watching their parents go through financial hardships during that time. And they watched them do that through their high school years. And so their belief about money, their belief about home ownership, all of that changed. All of that changed for them. Not to mention, I mean, we
Right.
can take it from the 15-year-old to the 18-year-old to the 20-year-old that was in college, 15 years ago. The way they saw money change hands or leave hands, so it were, and what their parents and their friends' parents had gone through with home ownership as well as employment shifted their mentality. So now you have a group of people that are not currently interested in buying. They want to rent. They want to be nomads. They want to be able to pick up and go over here and pick up and go over there. And really, fortunately for them, COVID happened because now, from an employment standpoint, they can stay at home and work. It doesn't matter where they are. Companies are hiring people to work for, Atlanta-based companies or California-based companies or Texas-based companies that might live in Wyoming, Mississippi, Minnesota, because they don't need to come into the office, depending on what their job is. So it shifts the dynamic. Adversely, what we're seeing there is companies paying them less money because they don't have to drive in and pay to park and buy lunch and spend
Right.
$7 on that coffee every day. So
Yeah,
they're
that
offering them less money.
COVID did really make a significant change in pushing people essentially out of the office building environment and into the home environment. I've got a great friend that works for AT&T, and she said, "Oh, I got to go to work now." So she walks upstairs and goes into a bedroom up there and closes the door and turns on her computer, and she's working. And I'm listening to her. She's got conversations going on. I'm thinking, how many people are in that room up there? You know, well, there's only her. But it sounds like there's she's having a board meeting, and of course she does IT work, and but that has really changed the landscape significantly. So now everybody can kind of move out into to the burbs. But to that point, rental rates have gone up quite a bit. I know somebody in my neighborhood that is renting, and their rents went up like 20% or better. 25%, single family house in the burbs. So that 7.1% is an average rental rate nationwide. So I'm suspecting that in your metro areas, the rent increases are higher,
Oh,
quite a bit.
absolutely. I mean, they're double
So
digit, double digits
what does
still.
all this mean to us as investors, though?
So for us as investors, it means that there's a huge opportunity, knowing that we're going to not necessarily lose equity, but have equity capped at some point here. We're going to have a correction. There's no questioning that.
or
Okay.
diminishing equity even,
I'm sorry.
or diminishing
Yeah.
equity.
Yeah, that's what I'm saying. We're going to have a correction, and that's going
Mm,
to happen to some extent. Whether you believe, that it's going to be 5 or 10% or 20 or 30%, as that's what some people believe. But
right.
there's no crystal ball here that we can look into and say this is what you need to prepare for, other than the fact that we know we're going to have that correction. Okay, whatever it looks like is what it looks like. But what we know, even if it's as modest as 5 or 10%, there's going to be a plateau. Then there's going to be that 5 or 10% depreciation or perceived depreciation of value. That's more of a perception than anything else. That is going to be solely driven by market conditions at that time. But you need to be ready to take advantage of that. They're telling you now, right now, go get your house before the rates go up. Go spend, go spend. And people are rushing to get these applications in so they can get approved and buy a house. They're rushing to do that. As I mentioned before, it's over 8%. It's over 8, it's closer to 10% now, of an increase in mortgage applications right now before the Fed meets again in March, right? So as those interest rates are going to go up, we're going to see values plateau. We'll see more and more people going into rental properties, apartment buildings. All of the apartment buildings they're building now, all those assets that they're building are Class A assets. They're not building Class C assets, meaning they're not building affordable apartments. They're building
Right.
apartments that are $2,000 a month for a one-bedroom apartment, $2,400 a month for a two-bedroom apartment, and so on and so forth. They are building these things that are pricing people out. And to go back, Steve, as you pointed to go back into this article here in 1, 2, 3, 4, paragraph 4. We're not going to read the whole article, but again, I'll link it in the description for you to read. But in paragraph 4, it says right now that the average apartment renter is earning $70,000 a year, with expected wages rising strongly at 3.3% per year. But my question to you, Steve, is a 3.3% annual appreciation in salary enough to keep up with one, inflation, and two, these double digit rises in um, um,
Well,
rental
I'm
numbers?
not a math major, but if you've got a 10% rise in your rental pricing and a 3% rise in your income, there's a 7% gap there. So, no, the
Well,
answer would be absolutely not.
absolutely. I mean, if we mathematically speaking, and I don't want to confuse anybody here, but if we take that, right, if we take the fact that the average American, as it states in this article, is spending 30% of their annual salary on on their rent. 30% of that 70,000 is $21,000, right? $21,000. A 3% increase on a $70,000 salary is $2,100. Let's call it $2,200, right?
Yeah.
It's a wash. So those 10% increases on that 21,000 is $2,100 a year, but you've got an increase of $2,200 a year. So you make $100 more. You feel like
Great
you're
point.
winning, right? But it's a wash. So that means that the wage that you're receiving, the living wage that you're receiving, is just enough to keep up with rent, not everything else, not inflation as it relates to your gas, your food, just all the other necessities and essentials you have in life. That $100 a year is not going to be enough to cover the
Mm-mm.
inflation, okay? Because inflation is generally at around 2.6%. We're 3 times higher than that now, okay? So you've got to prepare yourself for these kind of things and look at the numbers inside the numbers. Now, as investors, because that's who we're speaking to right here, right now, as investors, you have to see that the value is right there for you. If you can't go out and buy the house that you want to fix and flip and make, 50, 60, 70,000, I think the average right now is right at around 46,000. It used to be 62 or 66, but now it's into the 40s because of the increased, cost of materials, increased value, and that number in some cases is going down. Depends on what you're focused on. But if you're shifting and you're saying, okay, we're going to play the cash flow game, we're going to play the long-term asset value game. We know that there's not a ton of equity. We're not doing an equity play right now because it's hit or miss. We're going to take our resources and we're going to focus on the rental market. And there's several different places that you can do that with, right? You can do your typical, 12-month lease, be a landlord. You have lease option opportunities where you're the bank, right? And you have Airbnb opportunities that those are absolutely spectacular. They're killing the hotels right now. I mean, literally killing the hotels. So you have options there, and you just need to understand how to work those options because yes, Steve, yes, it is a viable technique and strategy right now to focus on rental properties or a buy and hold strategy with however you're renting them out, owner financing, Airbnb, but a buy and hold strategy, or better yet, an acquire and hold strategy. Because a lot of the strategies we teach, especially with what we know is coming up with the foreclosures because of all these forbearances and all this stuff going down, we know that we'll be able to take over some of that real estate, right?
We were talking sometime earlier about cycles.
Hmm.
A good while ago, I bought a house, and it was outside of what I normally do. I like to buy, back then I was just buying vacant houses, flipping them to other investors. Well, I came across this one that had a tenant in it, and I said, well, yeah, I think I'll buy it anyway. And I just left the tenant in there and collected the rent and did what I did. I sold it, 6 months, a year later, 2 years later, I can't remember. And I ran my numbers on it, and I said, wow, this is pretty good. I pretty much had a zero holding cost because now I wasn't paying, the rent offset the interest expense that I had on that property. So when I sold it, of course I sold it for more than I bought it. So that was all profit right there. So if you just take that approach, and now your only job really is, you buy it right as you can. It doesn't really matter so much if you're on a long-term thought basis. It doesn't matter if you're going to get it for a few dollars more than what it's worth or a few dollars less or whatever. You're in for the long haul, but you're kind of looking at, okay, the cash flow. Can I get some cash flow out of it? Positive cash flow would be great. But now it almost doesn't even matter if you do that, as long as you're break even cash flow, and you've got your income coming from somewhere else. Naturally, I like positive cash flow is always better for me. But so now your only job after that, and once you get that set up, is just do more, and then your job is one thing:
Hmm.
stay alive. That's it. Just live. Keep living, and then when the cycles change, sell. And follow that adage: when everybody's buying, sell.
That's right.
When everybody's selling, that's time to buy.
Well, shameless plug. When there's blood in the streets, it's time to buy. By the way, that's the name of the book. You can catch the link in the description below.
Yeah.
But I mean that's the truth. I mean I think this is just me, and again, I'm not an economist. I'm not a specialist, for whatever news media outlet you like to watch.
So
But
you're saying you're not giving any financial advice
I'm
here.
not
This is
giving
just
any
for
financial advice.
entertainment purposes only.
Entertainment purposes only.
And we're
That's it.
doing, yes, sir. And
That's
we're
right.
just,
I
got
look
our
at the
own
numbers.
opinions.
That's right. I look at, Zillow thinks that rates are going to, or home values are going to increase, by like 14% by the end of the year, right?
Yes, but didn't Zillow just make a huge play in buying a whole bunch of single family houses and lost their shirt. So
They
should we
absolutely
be
did.
listening to them? I'm wondering.
Absolutely not. But that's what
Yeah.
is out there. You're not getting the data from. Most people aren't reading the data from CoreLogic. Most people aren't reading the data from um, uh, Realtor.com or even MLS, believe it or not, which has it at a much shorter clip. Some of them, Fannie and Freddie are thinking it's going to be somewhere between 6.9 and 7.1, and and if you just meet in the middle there, right, and say yeah, because CoreLogic thinks it's going to be even lower than that. CoreLogic is more along the lines of what I think, but keep in mind, CoreLogic is the company that collects data on employment, late payments on your mortgage, late payments on your car, late payments on your credit cards. They've been collecting this data for decades. Okay, they can predict patterns based on people's movements, and so I'm more inclined to believe that their numbers are going to be a little more accurate, maybe at about a 2% clip. Okay, that's where they're at now.
2% increase in home prices?
Right,
Okay.
2% over the
And
over
that's what you
22.
think?
I think it's going to be somewhere between there and the median, somewhere between there and seven.
Okay.
I think it's going to be somewhere between there. I don't think we'll be at a loss immediately. I think we'll be at a plateau before we get there. And that, again, is going to be a national average. You're going to have pockets in this country that are going to lose value. You're going to have pockets in this country that are going to gain significant value, significantly higher than that. But on average, that's where I think we're going to wind up. But also on average, we're going to see rental numbers increase at least 7%. At least 7%. Depending on where you are, it could be higher. But I think that we'll see that rental values over the course of 2021 or 2022. By the end of 2022, we'll see. We'll look back and say, yeah, there's about a 7, 8, 9, 10% increase in rental value, which tells you that you need to go and play the cash flow game, right?
Now you said that in last week's show you said that by the end of this year you think we're going to be in a negative equity situation.
But
Did I
so
hear that right? Did I remember that right?
well, but as I just said, in some pockets we're going to be under. They will lose some value,
Okay.
some
Okay. In the
and
pockets.
right, and that's why I think the national average is going to be somewhere between 2 and 7 in terms of appreciation. That is, we know for sure that there will be pockets of the country that will have lost value. We know
Hmm.
for sure that'll be the case. I mean, if home values, national home values, do not appreciate above 7% over the year. That's
Wow.
my that's my novice opinion on where I think we're going to be based on my belief that we'll have those three rate increases by year's end, which will, as you stated before, will slow demand down. People will buy less because it costs more, right? And that
Yeah.
eventually will bring the prices down. It's a basic supply and demand, expansion and contraction, right?
And we can't tell the future.
No.
Just be aware of that. No one can. No one knows the future. It's all a set of probabilities. So we're just saying, okay, what are the circumstances now, and what's most probable to happen next?
Hmm. That's right. I I like that. He's my lawyer, by the way, guys.
No, I'm not. Not your lawyer.
he cleaned that one up really, really good. But I think that that's where we're going, Steve. And for the people that are listening, we have already. I mean, we're looking. Our campaigns look for everything. We're marketing constantly for wholesale deals. We're looking for fix and flip opportunities that make sense. We're looking for buy and hold stuff. We're working with hedge fund companies that are looking for very specific things. It's we are preparing ourselves for the shift by doing the work right now, by creating the relationships, getting the get to know you campaigns with people that aren't ready to sell today but will be in 3 months, 4 months, 6 months, and they will be open to creative financing opportunities because unless you're super well connected and you've got a ton of liquidity that you can leverage, it's going to be you're going to have to be a creative investor to take down the abundance of real estate that's going to be available to us, I believe, over the next couple of years.
I think you hit the nail on the head when you said creative financing, because really it's about the financing. I
Mm-hmm.
mean, if you're paying a 15% hard money loan, there's not much opportunity for you to turn around and rent that house and make any money,
Yeah,
because your lender's going to make all that. So,
yeah, yeah.
and a hard money, private money loan with a high interest rate, you've got one option, that's sell the house, fix it and sell it,
Mm-hmm.
or just sell it, or whatever you're doing, whatever your plan is. But if you've got the flexibility, I mean, we just did a house, we've expanded you were talking about all the different things that we're doing. In addition, we're expanding our market area to certainly the Southeast and the Midwest.
Mm-hmm.
We're doing houses in Mississippi, Alabama, Florida,
Iowa,
and Illinois, and
Ohio.
Ohio, whatever. Wherever there's an opportunity, and it's
Yeah,
not about the location anymore.
yeah.
It's about the data and the opportunities and the imagination and the financing that you have. You know, we just sold that house in Mississippi, but it was a structured situation where we put together the private money and the individual that wants it, and it's a fixer upper. It's just what it is. Just finding the components and putting that jigsaw puzzle together,
Steve,
making a whole picture out of it.
you have a wonderful saying about opportunity and imagination.
Yes, sir.
Can you?
Opportunity. Yeah, we can. People that like I like to say, and Miles is liking to say it too. It's just, people just run out of imagination.
Mm-hmm.
And that's where we can step in, because our imaginations are a little larger. But that's all about it, just having more information at your fingertips when you're out there investing, in terms of, okay, how can I handle this? If you're, if we mentioned in last week's show, if you're just a wholesaler, you have one thing. You reach in, you got your wrench, and that's it. Maybe it's an adjustable wrench, but that's not enough. You need a pair of pliers, you need a saw, you need a hammer, you need all those other things to have a complete toolkit to invest in real estate. And there's a lot out there. And I'm not saying that, I know everything, but Miles and I have been around the block a few times. We know a lot. And we don't even know how much we know. And so we start talking to somebody who says, wow, I never thought of that. I never
Yeah.
thought of this. We take a lot of it for granted,
Yep.
Miles, you especially.
And we do that for sure. But we do that in our conversations. I mean, we still do that to each other today, and
Yeah,
that's just because sometimes you can be so on top of it that you can't. You're so micro that you're missing the macro, and it takes the other set of eyeballs to say, well, what about this? This is right there, and it's like, oh, okay, because but that's the benefit of having that collective mind and not being the 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 person that thinks they can do it all by themselves, because you simply cannot. You
it's
know.
it's huge. We've all got to have a muse of some sort, whether it's you call it a mentor, you call it a partner, you call it, just anybody. It doesn't even have to be somebody you work with on a regular basis. You go to these meetup groups, or you go to whatever seminars, you hang around with other real estate investors. And it doesn't even have to be in your business, as long as it's, some kind of something parallel, like people who are buying and selling businesses, for example.
Hmm.
You can listen to that and get ideas that you can convert into your investment business, or your whatever business you're doing. Doesn't
That's
matter.
right. It truly doesn't matter. What's most important is that you take action. As you're listening to this, I want to say, if you want to know more about some of the creative financing structures, the marketing piece, just reach out to us. I'm definitely going to have some links in the description below for you to contact us, set up a private consultation, so that we can see what's best for you, and hopefully be on a road to working together with one another. Because the reality of it is, these opportunities will constantly shift and change. Your job is to be able to identify those changes and where you can fit yourself in. How you do that the quickest is by working with people that have already been there, that are already doing it, so that you don't have to figure out how to how do I get my balance in this situation? Do I stay still? Do I move left? Do I move right? What do I do? What do I do? Do I change courses all the way? Don't be that person. Get yourself somebody to talk to. As Steve just mentioned, we are happy to work with you. Just hit a link below. We work with people all around the country that are investing in everything from land to multifamily, single family. We work with everybody
You
in
know,
any situation.
if you've ever been to one of those, 3 day, $2,000 free seminars,
That's right.
as you call it, so it looks so clear when they put it up on the board and give you examples. I mean, it's like, oh wow, anybody can see that, right? But then you get out and start looking at all these houses, and nothing looks like the one that they showed you on the board
Mm-hmm.
at the seminar, and it gets confusing. So then what do? Most people stop because now they're out of imagination because well, it doesn't look like that. It only works over there. It doesn't work over here. It works everywhere, but you may not know that. So that's what I think you're talking about
For
right there.
sure, absolutely. So I encourage you guys to take action. Don't miss out on this opportunity because it's in these opportunities, it's in these moments. We're on the precipice of a new wave of millionaires and multimillionaires being created because of what's coming. You have to you have to have foresight in your investment options. You have to have foresight in your investment partners. You have to have foresight with your educators. But you have to take advantage. See who works best for you. See where you want to go with your investment opportunities moving forward. But know that you definitely need to be working on your creative financing and your marketing. We're here to help you with that, understanding exactly how you could take advantage of this upcoming rental market and win and position yourself to really, really be good in the next 2 to 3 years. So this is your man Myles, and
Hey, Steve Conley, unemployable. Hashtag.
we wish you all the best, you guys. Talk to you next week.